Hi, everyone. Thanks for joining us for this webinar on COVID, the tech acceleration, and how that's impacting on real estate and REIT markets across Asia Pacific. We're delighted to have with us a great panel focusing on all aspects of the real estate market, proptech as well as REITs. Structure-wise, it's going to be very similar to a typical research kind of presentation that you guys are familiar with. JLL is going to start off with a broad macro picture of where we are in real estate markets. They also launched office blocks recently, so also adding that big data, AI elements to forecasting. Then we'd have unique insights from proptech leaders on what you're seeing in their spaces and how what they're doing are impacting real estate markets before we wrap up on how that's all playing into REIT markets, valuations, as well as prospects for the future. In terms of Q&A, etc., please enter them into the chat functionality at the bottom. You have a Q&A at the bottom of your screen. You'd find the Q&A functionality as well, chats, etc. So you can use those. Questions, the speakers may decide to answer verbally if they receive them, or they could also respond via text in the Q&A functionality as well. Okay, with that, let's start with our first speaker, Roddy from JLL. He's the head of research for AsiaPac at JLL, and they recently launched Office Blocks, a novel AI approach to real estate forecasting. Roddy? Roddy, I still on?
I think you're on mute, Roddy.
Sorry, just give us a second. Alternatively, Christina, would you like to start? Would we be able to start with you?
Not a problem. It's my pleasure. You can hear me okay, Noel?
Yeah, we can hear you okay.
Perfect. So my name is Christina Tubb, and I am the manager for ProxyClick for APAC and the Middle East. We've traditionally been in visitor management, which has seen an enormous shift over the past year with COVID. I'm not sure anyone in our company has ever worked quite so hard as we have over the past sort of 6, 12 months. So it's been pretty interesting. What I wanted to do today is kind of share a bit of that shift with you and how different members of our community of 3,000 customers are actually responding to that shift in their real estate. So let's pop up a couple slides here. So what we provide is modern people flow management for modern workplaces. Where we used to be is that everyone was welcome, with the exception of maybe a high security site or something like that. The default was that people were generally allowed to come into buildings. And it wasn't until they got to sort of a locked door that perhaps they would not be welcome. Now there's a big asterisk around that. There's a lot more questions that we need to ask. So the response that we saw at the beginning of COVID across our real estate partners, and this is kind of ranging from large corporate organizations down to tiny SMBs, was spreadsheet overload. So looking at some of our buildings that we're running in New York City, 60 stories, lots of tenants, or even Brooklyn Navy Yard, 320 tenants. All of a sudden they had temperature scan spreadsheets, staff declarations, front of house declarations, tenant level declarations. Absolute mess to manage. At the same time, margins are getting squeezed for building operators. So they needed something that was a bit more integrated, that was able to help them to respond to COVID. And kind of what we've seen is throughout this is that REITs, building owners, portfolio managers, operators require portfolio level intelligence. so that someone can come to them and say, can you declare that everybody who comes into any of your buildings, shopping centers, has gone through the appropriate legal declarations to say that they're safe from COVID in line with your local jurisdictions, as well as your global policies. The second bit is, do you have integrated workflows? So your thermal scans, your NDAs, your compliance, everything is all in one place and it's all connected, so that you're not running around with like chickens with their heads cut off the second that something goes wrong. So really getting ahead of those problems and not just overloading staff with a lot of manual processes. And the next one that we really had a lot of questions around is, are my tenants going to renew? How can I figure out if my tenants are going to renew? Footfall is a huge part of that. Are they bringing externals in for meetings? Are their own staff coming into the office? How many people are actually using these spaces on a day-to-day basis? And so this is quite important, not just from a corporate real estate perspective, but also retail, kind of understanding what that footfall looks like. This is a unique opportunity for us as real estate professionals to start harnessing a bit more data on footfall that's either anonymous through sensors or a bit more targeted at individuals, so you can start getting a bit more information on who exactly they are. And one of the big outcomes that we're seeing that is around staffing. Margins are definitely getting squeezed in terms of the operating space. So we're providing a lot of data into our customer base so that they can understand, okay, we've got the majority of our footfall happening at 8 a.m. and 9 a.m. on Wednesdays. So we need to work on our cleaning rotations for that point, but then perhaps we can redeploy that staff elsewhere at other times in accordance with it. Bringing it all together, what we're doing at ProxyClick is helping our customers with 4 elements. The security element, so before it really used to be physical access control, integrating with that and really kind of focusing on, data privacy and who's coming in. Now it's kind of overall security, including biohazard. But at the same time, it must be all connected together, right? Having those disparate spreadsheets on a tenant level, building level, portfolio level just cannot make sense. So it must be connected between one another for it to be more efficient. Always staying in line with ever-changing compliance. So the approach that people are taking is increasingly a flexible one versus these kind of built in-house Frankenstein approaches. And then finally, really putting the brand first. Because what we have discovered within a lot of our surveys is that clients, visitors, staff really prefer to work with a company who values their health, safety, and privacy. And that's going to be a big differentiator for what people are able to provide in terms of a physical workplace or retail experience in the future. Never mind the fact that there's massive liabilities if people do it wrong. So it's quite important to have that balance there. Overall, we're doing a lot of things to try and tie up these pieces. What I was going to show you is a very short video here on how we're tying up the pieces for employees in a corporate office environment. As I pop that over, Joel, I just wanted to see if there are any questions that anybody had brought up during the Q&A here. Okay, cool. So for staff, many companies are having trouble getting their staff to come back into the office, number one, and to have a good idea of when and how they're going to be coming into the office, right? So how they're going to be collaborating with each other and so on and so forth. So what some customers are doing is, rather than necessarily needing to book a desk or anything like that, is just for someone to say, yeah, I do intend to come into the office. So I'm going to come in the office this day, and perhaps they'll book a desk using one of our partners' tools. Our real goal here is around safety and EHS. So pushing that against the occupancy levels. Now, the day before, the morning of coming in, there will be screening questions relevant to COVID, to the various rules that are in place for that day, for somebody to actually come on your site. Now, you might have global rules across the portfolio and local rules for that particular site. So that sort of matrix level compliance. Now, the person will come in, and then what you can do is you can do a thermal scan right there, which will then connect in with the person, and that'll move them from their expected to their checked-in status. So then this means you start to have a global vision of your staff, your contractors, your visitors, who's come in site, and who may have been in contact with one another over the last 14 days. Obviously, for your more advanced buildings, we're connecting in with access control systems, and for your simpler tenants, we're doing this on a kiosk basis. Finally, data privacy is quite important. So all those elements around sort of checking in and checking out and tracking staff, we do have to make sure that we're providing an additional value for the staff around that, and that we are removing the data when it is no longer necessary. I'll just pop that back up there. So that kind of brings us to the end of the little moment right here around what we're trying to do. The big thing for me is helping staff, and in many cases sort of very overworked HR teams that have been really just pushing so hard over the past 12 months to get their teams to return to the office with ease. So provide staff the comfort and the security that you're taking their health and safety appropriately. Really provide something that's value added and connected. And then give the portfolio managers the data that they require to be able to manage right the way across the ecosystem, so that they're able to make decisions around cleaning, around health and safety, with a really good understanding of what's required now and in the future in terms of costs and investments. With that, I'm going to stop sharing and answer any questions that people might have.
We could also do the Q&A at the end on a rolling basis, depending on when they come in, because the questions just pop up on the screen at the bottom. Perhaps we'll rotate back to Roddy then.
Thank you. Can you hear me now this time, Noel?
Yes, we can hear you.
You can. Okay, apologies everyone. For some reason, I was using Teams before my audio, even though we tested, it didn't work. But thanks for everyone's time today. I mean, certainly 2020 has been an incredibly challenging time in many aspects across the world, economically and for many businesses. And that also has applied very much to the real estate industry. As we heard from Christina, definitely a lot of challenges with getting employees back into workspaces. And what we've seen in reality when we look at the investment market is investment volumes down within the real estate industry in terms of direct investment into assets, down by more than 20% this year. And similarly on the leasing front, we've seen gross leasing volumes down by about 25% year to date in APAC. And this is really coming at a time where we're at peak supply in the office market. And very much as we go into 2021, that peak supply will continue, with about 7.6 million square meters coming to the market in aggregate across APAC, which is essentially about 2.5 times the Singapore office market. However, sort of positively as we move forward, and there's certainly been many questions put out there in terms of will people return to offices, will people take, will major corporate occupiers take half the amount of space in offices? But our thesis is very much that the office will remain central in APAC, and we're confident in the future of the office as we move forward. And indeed, we surveyed corporates and major investors in Asia Pacific in terms of their intentions going forward. And what they're telling us very clearly is that they remain confident in the real estate markets in Asia Pacific. And if anything, Asia Pacific is likely to accelerate out of this more strongly than before. Now, we already know that there's roughly about $40 billion in dry powder. So that's capital just waiting on the sidelines to be deployed to invest into real estate markets here in Asia Pacific. And of the major investors that we surveyed, they have roughly about $2 trillion in assets under management here in APAC. What they're telling us very confidently is that they expect over the next 18 months to deploy a considerable amount of capital into the market here. And with all of that in mind, one thing that we've been very focused on in JLL as we move forward is to look at AI and proptech and how that may help businesses and investors as we navigate through this time and in very challenging situation in the future, where we have a huge amount of capital attracted competing for assets here in APAC. And as a result, JLL has invested in a new company called Office Blocks, which is an AI-driven machine learning platform that looks specifically at office assets across Asia Pacific. So what I thought would be possibly interesting for everyone today is just to show how this AI works. So let me just share my screen. So what JLL has done is to take all of the real estate data that we're quite famous for here in the market in Asia Pacific and from our REIS platform and everything that we can gather information-wise, and to feed all of that into essentially a very cutting-edge new platform that we have developed. Now, there are limitations in terms of, the amount of manpower that you can put behind tracking markets. And typically, if we look at the Hong Kong office market, which I'm zooming into now, we've been able to, on a manual basis, track roughly about 150 office assets every quarter in a very detailed way. But through using AI and gathering, essentially casting a net very wide and gathering as much information as we possibly can do on the market that's out there publicly, is to feed all of that into a machine learning platform. And that allows us to now track roughly about 900 assets in the Hong Kong market on an ongoing basis. So I'm just picking IFC here, a very famous building in Hong Kong. Now, all of the information that we've got here in terms of rent, that is being driven by AI. So the end user, essentially the investor, can very quickly look at any asset across the key markets in APAC. They can see a quick snapshot of the asset, and they can also see essentially the effective rent that asset, this is mid-floor level, that asset is able to achieve in the market. And we've got a rent confidence in there. We also, if you think about it from the investor perspective, it also allows them to look at comparables. So if I click on find similar buildings, the machine itself is able to essentially come up with these comparables. And as you can see here, I'm basically adjusting the various parameters for the comparable assets that we want to pull up. Now, all of this would take a considerable amount of time and effort to gather and analyze and get these comparables in the market. Whereas what we're trying to do here through the power of machine learning is essentially to bring this information to the end user instantly. Now, that's just one component of how Office Blocks works. And let me just quickly show you one final piece of the platform before we move forward. I'll jump to Singapore just to show an example here. So here we go, Singapore. And I'll pick something completely out of the realm of even the office market. So let's go to Club Street in Singapore. Now, what we've also done with our joint venture partners here and looking at machine learning and AI is in actual fact to gather images of hundreds of thousands of essentially commercial assets across Asia Pacific and to feed all of those into the machine. Now, we're using a very similar technology that's been used in the medical industry. Machines can now more effectively essentially spot cancer tumors than a human being can do more accurately. We've taken that same level of technology and essentially fed that into our platform here, but actually had the platform use the same technology in AI, but to actually analyze commercial assets. Now, I'm picking a shop house. We actually haven't trained the AI on shop houses at all. It's purely on office assets so far. But I just want to show the versatility of the tool here. It's asking me, is it a building, which means I've taken a very bad picture here. So apologies for that. But now essentially what the AI is doing is scanning purely that image to look at what the size of this asset, the likely size of the asset, the number of floors, it's looking at the location, and then it's casting a net completely across all of the assets that we track in Singapore to then look at what is the likely achievable rent for this asset. Now, number of floors, it says 4, probably because there's an in-between floor here. It says grade B because that's the lowest grade of asset that we're tracking here in Singapore. But the most important thing to look at here is the AI estimated rent. And through the power of AI, essentially what we are able to do is even within these shop house assets here that we're not even feeding into the platform, we're able to get within about 10% accuracy of the rent there. So the idea being, even if there's an asset that we don't have fed into our platform here, that we have a nice little red pin that you can look at the information, you can simply go to that asset, snap a picture of the asset, and hopefully get rental information with an accuracy of roughly about 10% within the market. And this technology, we have a free-to-air version that is available on mobile, but we also have this very detailed desktop platform that we have developed for investors. And just before I wrap up, what we have tried to do with Office Blocks is really to create convenience for investors. So we have one other platform here, which is our portfolio intelligence platform. And essentially what that allows the end user investor to do is to essentially feed in information on various different markets. So Hong Kong office, 100 million invested, and Beijing office, 600 million, Jakarta office, 500 million, and to look at the likely return and also the volatility or risk from that combined portfolio of these three assets. And to very quickly look at, and if I add in here Singapore office, $1 billion US. If I was to look at what happens to my portfolio if I add this asset, we can see that we've moved from the current portfolio to the new portfolio, which now includes Singapore, and we've managed to slightly improve our return and also diversify some of our risk. So we very much see AI and these new tools as sort of creating transparency, empowering people to be able to make smarter and quicker investment decisions. And in a market, as I mentioned, where there's 40 billion in dry powder sitting on the sidelines, and that is highly competitive, it will hopefully allow those end users to have a much sort of faster advantage in the market. And with that, Noel, I will pass back to you and happy to answer any questions.
Okay, thanks, Roddy. Next up, we've got Yuying. Yuying is the founder and CEO of Esevel, a remote work platform that helps companies simplify the management of their remote workforce. Yuying?
Hi, thanks, Noel. Let me just share my screen here. Okay, can you all see my screen?
Not yet.
All right, do you see it now?
Yes.
Yeah.
Okay, fantastic. Hi, everyone. My name is Yuying, and I'm the CEO and founder of Esevel. We founded Esevel in April this year, just as lockdown began, although I've been in the corporate real estate industry for the 6 years prior to this. And we did this basically because we saw that companies would need a management system when they go from thousands of employees in one location to 1,000 employees in 1,000 different locations. So because of this new company, I've had a very front row view on companies' challenges with remote work and what their real estate plans are. So we've actually formed 5 insights during this time, which I'd like to share with you. So the first insight that we've had is that from speaking to many companies, a lot of them tell us that work from home or work from anywhere, as a lot of them like to call it, is here to stay. Basically, COVID has forced businesses around the world to enter into a global work from home experiment. In Singapore itself, nearly 60% of employees have ended up working from home, and I'm sure many of you here today are working from home. So this has broken through the biggest mental barrier that many employers had towards work from home employees, which is that they were not as productive working from home as compared to working from the office. So COVID has really disproved that notion. As you can see from the research, 68% of employees report working successfully from home. 70% of their managers actually agree that it's the same or better for their team's work performance. And because of this, 84% of companies actually report that they're likely to continue remote work capabilities in some form or another, even after COVID is over. So there are a whole host of benefits, as I'm sure many of you are aware, towards work from home for employees. You have better work-life balance, you can arrange your time around your family commitments and so on. But from the employee's perspective, there is also a lot of benefits as well. So there is no or little loss in productivity from your employees. And in fact, you have improved morale and you can still keep employees on track using software. But I think where the most interesting part of it is actually from the CFO's perspective, that shifting to remote work actually means that you may be able to cut down on your corporate real estate costs. So I'm sure, as most of you here know, rent and facilities costs make up about the second largest cost component for many companies. So this is the second largest cost component outside of compensation costs. I think for many companies, it amounts to about 10 to 20% of personnel-driven kind of expenditure. So being able to trim real estate costs or manage it is a very attractive proposition for many companies involved. So anecdotally, I'll be interested to hear from the other speakers on the panel as well. A lot of companies that I've spoken to whose leases are coming due, they have not renewed like certain portions of their floor space. And for some of those, whose leases are not yet due, they are a bit reluctant to sign on new office spaces, even as they're increasing their headcount. So this is what I've heard so far from the industry. The second insight that we've had is that offices will definitely not disappear, as Roddy has said. However, they could be right-sized. So, recent surveys, I can only point to US data for this, but recent surveys of COOs, indicated that 1/3 of them plan to reduce some form of office spaces in the coming years as their leases expire. And if you look at the survey over here, which was conducted by Cisco in October 2020, a US-based survey, almost a quarter of respondents say that they will be working from home more than half of the time. So with a partial kind of remote working workforce, perhaps there isn't that much of a need for office spaces, and office spaces could be resized and repurposed. So we then come on to the third insight that we've seen from going around the market. We feel that the concept of an office itself will change. So offices will be repurposed. COVID has caused leaders of many companies to realize that there are actually multiple facets of work. So you have your quiet focus work where you deep dive into issues, and these are probably best done from home. And then you have your noisy collaborative work where you do whiteboarding with your team members, and these are probably best done from an office or co-working space. So many companies are looking at adopting a kind of remote work hybrid model that blends the best of both worlds. So here are 6 possible forms of hybrid models along a kind of like hybrid virtual continuum. We've highlighted in red what we've seen to be most common here in Singapore. For the one that you see at the top, it's a partial remote work with a large HQ kind of scenario. And we've seen companies like DBS and UOB recently announced 40% work from home. So, this is the model that they're going for. And then further on below, you see a partially remote work with flex space. So we've seen this to be a lot more common with SMEs and with startups as well, where they actually work from home the majority of the time. However, they retain a membership to a form of flex space, which they go to for in-person kind of collaborations. So this one we also see to be quite popular. I think that the concept of a company has really changed, and people are now reimagining that it will be a place for collaboration. It'll be a place for employees to go to renew and to strengthen bonds with their colleagues. And it will be a place where new employees are onboarded and that they will get to know what the company culture is like. However, for deep dive focus work, I think that home is a good option that many companies are looking at. So you can compare an office almost to the office in the new era, almost to a kind of clubhouse where people go to it for social purposes. So of course, with the right sizing of office spaces and the possible shifting of workforce away from CBD, other types of properties might also be impacted as well. So restaurants, bars, and shops that service office workers may experience shrinking demand, and even residential real estate may be impacted by this. So there could be less of a demand for shoebox-sized apartments in the CBD, and there could be more demand for larger homes with space for home offices in the suburban areas in Singapore. So we move on to the 4th insight that we had. Which is that remote work will be a double-edged sword, could be a double-edged sword for co-working spaces. I'm sorry, let me just backtrack that. So it could be a double-edged sword for co-working spaces. So why do we say this? If you think about it, many of the smaller companies right now are co-working space tenants, and they may not return to co-working spaces because they find that their employees can work just as effectively from home. However, I've seen a lot of renewed interest in signing up for co-working spaces from larger companies who have decided to adopt one of those hybrid models of remote work. However, if you look at the distribution of co-working spaces in Singapore, which you can see on this map, most are centered around the CBD location. So this is not ideal for larger enterprises because if employees have to travel all the way down to CBD to attend one of the co-working spaces, why don't they just come into the office? So we think that there's opportunity here for co-working spaces to actually build new outlets in the areas where there are very large residential population. So I give, for example, Punggol or Bishan or Jurong East. You can see that there are not many co-working spaces over there. However, there are remote employees over there for whom such co-working spaces could cater for. Given that residential population is relatively spread out around Singapore, you have to be a relatively large and more deep-pocketed operator in order to build that many outlets. So we think that this points towards 2 possible things. One, it could be a consolidation of smaller co-working platforms. And the second is that there could be an increase in co-working aggregators who aggregate co-working spaces. And we move on to the fifth insight that we have seen so far. And this is that we think that remote work will supercharge the government's urban development plan. I think that, as most of you probably know, the government's 2019 Master Development Plan involves creating business districts outside of the CBD area. So for instance, they have plans for Punggol, for Bishan, for Jurong East, and for Changi as well. And it also involves changing the CBD from a largely commercial area today into a mixed-use downtown into the future. So I think that the shift towards remote work is only going to supercharge this. Pre-COVID in Singapore, I think that we can say only about 5% of the workforce regularly works from home. So a shift to even 15 to 20% of the workforce working remotely more often could have a very profound impact on how land is being used. In the CBD areas, there could be companies possibly moving part of their offices out and fewer people commuting in for work. So this gives an opportunity to retrofit some of the vacant office spaces or vacant lots into retail, residential outlet, or even public areas. And this could make the CBD become more alive during the weekends. For suburban business districts in places like Punggol, Bishan, or Jurong, there could be companies moving in, or probably more likely, more co-working spaces being built. And restaurants and shops, that cater to work from home crowd, that's an opportunity for them over there. So this can rejuvenate, some of the suburban areas in Singapore that we have and make it easier for the government to bring jobs closer towards people's homes. So my view is that remote work actually accelerates the government's urban development plan. I wouldn't be surprised to see that if there's a policy push towards it. I'll be happy to take any questions either now or towards the end of the presentation.
Thanks, Yuying. I think a question did come up in the Q&A functionality,
Okay.
which is, I think, largely around office REITs and what these work and home trends that you see, what impact will they have on office REITs and perhaps even office prices?
Sorry, Noel, are you asking me a question? I couldn't quite catch that just now.
There was a question in the Q&A that came up, largely around what some of these work from home trends that you see, what impact will they have on office REITs and perhaps office prices in general? Do you see like a bit of a hollowing out?
I think it's difficult to say right now. I mean, to be frank, a lot of companies are still at the stage of making decisions. And, a lot of this will depend on how fast the vaccine comes into Singapore. So the longer the holdout for the vaccine to come in, the more used people will be to working from home, and the harder it may be for companies to get people back into the office again. So if work from home becomes almost like a kind of default posture for a lot of people, and many companies have actually conducted surveys which indicated a lot of their employees actually prefer to work from home, then I think that there might be an impact on office rental in the CBD area. However, with that change as well, there are opportunities, I feel, in other possible business districts here in Singapore.
Okay, thanks for that. Roddy, we've got a question for you as well, actually, largely around the functionality in your system. The question is, to what extent do you capture the owner information or maybe even tenant information in your system?
Sure. I mean, the actual specific tenants we don't capture in the system, and the actual ownership at this stage we don't capture either. It's purely sort of focused around sort of the rental and the rental performance of the individual assets just now. We do actually capture that information within REIS, which is JLL's existing data service product, but we don't have it within this platform. What we're really trying to do is to leverage AI to give a more granular building level piece of information here on rents.
Okay, cool. Thanks for that. Just to all attendees, there's the Q&A function at the bottom. So again, if you've got any questions, feel free to shoot them through and we'll either take them immediately or we'll hold them for the Q&A sections at the end of the webinar. So thanks again, Yuying. And let me just take some time to share a bit on some of the hotel market trends that we're seeing as well. So let me just share my screen here. So aside from my role at REIT AsiaPac, I'm also a co-founder of K Hotel. We ran 2 to 4 star hotels in Singapore. And I mean, all of you, I'm sure you know that the COVID pandemic has meant travel bans across most of the world and across Asia as well. And what you see there is that, you know, occupancy of hotels have dropped off a cliff. No tourist arrivals from most countries. So what we see as well is that the innovation in the hotel market has not been so much on tech, but more so change of use. Hotel operators and hotel owners are having to repurpose their space to alternative uses. And as what Yuying shared earlier, a lot of them have started adopting this work from home or co-working concepts and offering space for people who maybe their home is not the best place for them to work, and you know, they could try working from the hotel lounge or even some of the hotel rooms as well. Another one is a lot of countries have implemented curfews and stay home requirements. And some hotels have also reached out to this group where if you want to go out and meet with friends, or if you want to stay out past 10:30 p.m. in Singapore, for example, then one thing you could do is to book a hotel room and have a party. Well, the tricky thing there is that sometimes it's a bit double-edged, right? Because sometimes, you know, people, if there's a limit on gatherings as well, then sometimes people go a bit overboard, like in this case. But if the hotel is able to control the number of attendees per room, then potentially this is a viable second option as well. So what's the offshoot from that? What we saw is actually that the smaller hotel operators have been able to outperform the larger and more established operators, largely because if you're small, you're more nimble. To give an example, our turnaround time in terms of how we iterate our response to COVID is like 1 day. Unlike a larger firm where they might have a manager at the hotel level, you know, take a couple of weeks or months to kind of gauge the impact across the portfolio and how that compares to his peers, and then write a report to head office and so on and so forth. Before then, the response orders come down the chain again. For us, where we're small, we just ask our sales team to go out there, test the concept, see what works, and if it doesn't work, then we'll adjust. If there's feedback, if certain segments of the market is saying, well, yeah, we could take a couple of rooms and, you know, let's see how we go from there, then we very quickly retarget our entire approach in terms of outreach, marketing, and sales to tap this group. And that has allowed us to, well, not totally be immune to the impact of COVID. And you saw that as well, that in February of this year, when Singapore first announced its travel bans, our occupancy plunged just as much as the rest of the hotels in Singapore. But very quickly we recovered, and in fact are doing similar to we were doing pre-COVID. So what does that mean? For small hotel operators, I think if you're nimble and if you're able to capture market share and get your rooms filled up and get occupancy up, it means that you're able to go out there and get more properties in and gain market share to some level. Honestly, the international hotel operators are the ones that are suffering the most, because for them, a lot of their business is international business travelers, and now, you know, there's pretty much no international business travel. So they can't really charge the premiums that they used to for such a target clientele. Whereas for new startups, new lean operators like us, then it's a lot easier because we're actually selling the product. We're selling the room nights, and we can repurpose that very quickly, very swiftly, and thereby outperform the market through such nimble adjustments. So what we're seeing there is investors kind of get the story, and they like that we might be at the bottom of the COVID market. Perhaps the recovery story is anyone's guess, really, but I think there's positive news on the vaccines for COVID and how that's being distributed, and potentially that would see a recovery of travel, or at least the lifting of travel bans over the next one year or so. But I think importantly, regardless of the travel bans, small operators like us are able to fill our rooms quite efficiently, and that allows us to go out there and gain market share and build the number of buildings. So just to provide an insight, we don't actually buy hotels. We are actually a tenant. We master lease hotels, and then we operate them and earn the spread from that lease and sublease. So in terms of what we're doing next, they'll largely be around continuing to sign new buildings. We're constantly fundraising to build our portfolio. We are at 9 properties now. We were at 4 a year ago, and we expect to reach 18 properties in Singapore within 6 months. Some of the properties that are coming to market now are a bit larger than our current appetite. So, for example, because we master lease for a 100 mil building, might only put down 1 to 2 mil on that. Some of the buildings that are coming to market are a bit larger than that now, because a lot of them are sitting empty or at least under-tenanted. So for that, we're looking to raise a sub-fund, not so much to buy the building, but to go to master lease on a pari passu basis. Okay, so that's the hotel market, and I'm going to pause there. Next up, we have Bernie covering the proptech trends in the Asia Pacific region, as well as property management systems. Bernie is the regional director at Yardi, which is the leading property management systems provider for the real estate industry.
Hey, thank you. Thanks, Noel, and happy to be part of today's presentation. Thanks everyone for your attention. Assuming you can see my screen and hear me fine. So yeah, I guess I'd like to talk a little bit about a few things we're seeing. And first up to say that, yes, everyone I think was in a state of shock through to a state of denial, and ultimately to a level of acceptance. And I think that's really where we're getting to now. We went through a little while where people were talking about the new normal, and then they realized that they weren't quite there yet in terms of the new normal. But what new normal really was a situation where we don't know what's next, and that continues to be. And I think that's a key thing to understand also about tech and how that relates to this situation. So in particular, you know, you could look at this particular idea of where we've come from in terms of automating business process and starting off with manual, you know, mapped workflows and moving that through robotic process automation, machine learning, and ultimately to artificial intelligence, and sort of where we are today with artificial intelligence being relatively young and very immature, but definitely has capabilities to grow, which means I'd like to look at this slide in a different way, which is really to say we're actually about here in terms of what's next. So, you know, I think one thing is for certain, talking to senior people in real estate across the region over the last few months and asking them, you know, knowing what they know now, if they'd known that back in February, what do they wish they'd done differently? And a common theme was that they had decided back in February, March to invest more in tech, but in fact, looking back now, they wish they'd doubled that or tripled that investment, because they now understood that really that was one of the right things to do. And it comes back to a number of areas, but one in particular has been around data. And I think a recurring theme of what we see across the region when we talk to senior people in asset management and real estate is that they want to get a picture of their portfolio. They want it to be real time. So one of the key things since really, I'd say since MSCI included real estate in some core indexes, really changed investors' views. So institutional investors really moved much more into the real estate space, and REITs in particular also became more prominent as a function of what investors need to focus on. Excuse me. And as a result, the idea of having real-time data has become more important. Those institutional investors used to stocks and bonds, real-time data in that space. So when you come to real estate, you say, why am I looking at a financial report that's 6 weeks old? It should be real-time, right? And what people, I guess, have tried to do is go, okay, we'll do that, but not fully understanding what that meant in terms of starting off with a view that says, I need to build a solid foundation. I need my business to be based on solid data and solid processes so that the real-time information I present is where it needs to be. Because one of the challenges that I've seen is some organizations say, oh, let's just put a warehouse on the top and pull data off and make a nice dashboard without really addressing the underlying issues of getting it right. And now I think a lot of organizations are realizing that, in fact, that's a key thing that they need to address is getting the information right underneath, getting the core foundation of their data aligned, robust, and really making sure that the real-time data that's coming through to that dashboard on the top is based on accurate information from process rather than a series of worksheets or spreadsheets or whatever. So that's sort of some of the key things that I think we've seen that have has been a focus, is improving focus on asset management, improving focus on data, and a desire to really adopt some more key concepts in terms of AI, etc., and understanding how AI can be used to better understand the data that organisations have. So it's been interesting for us also as an organisation to look at how the industry requirements have changed. It was interesting. So one of the things that we've looked at has been, return to office, and this is a US-based product that we have that's very much focused on understanding, the requirements around returning to office and understanding the need for improved communication with tenants, employees, the need to focus on the ability to manage how much of a workplace is actually occupied and how much is available for occupancy. So without having to go and move the furniture around, but literally saying certain desks are not available, other desks are available, managing all that process and managing the compliance in terms of health check and all that sort of stuff as well. And at the same time, giving admins, giving corporate real estate admins the ability to deal with that and to change that and to manage that whole return to office process, if you would, and get the data associated with it for compliance purposes. So this is an example of some of the things we've done to focus on this space. Another example would be, very interestingly, at the beginning of the year, we saw a need to bring a new product into the space in terms of financials and addressing some key financial data points for our clients. And obviously COVID came along and we enhanced that so that it very much focused on collections, deferrals, abatements, and all those sorts of things. So really, I think we were in the right place at the right time. And I think, in talking to organisations across the region, which I try to do as often as I can, what we see is two sides to this. It's very much around making sure that the underlying data and business processes are efficient, effective, and get rid of all of the paper and make it all online. So relationships with tenants, relationships with vendors, with investors, etc., getting all of those parties interacting online, getting rid of the paperwork. That's both faster, more efficient, lower cost, and safer. And secondly, it's really a much stronger focus on data around compliance and around safety, and really making sure that the key things in terms of the whole process and what Christina was talking about earlier in terms of making sure that the health data has been collected, that processes have been complied with, and that reporting can be done. Really, really important stuff, and it's very much what we've focused on in terms of the process. And I think in addition to that, it's about making sure that not only are we enabling the front end process, in other words, for tenants and visitors to do what they need to do, but also connecting that with back end processes. So it's an integrated approach rather than little islands of information. There's some of the key things. And I think in the proptech space, we've seen that also very much with a real need for proptech companies to pivot and focus on the here and now, so the short term, and being able to fill needs in the short term rather than in the long term is really, very important. So yeah, I think it's a sort of a summary of what we've seen. I've looked at organisations everywhere from Korea through to Australia and New Zealand, right across the region. So yeah, happy to take any questions. Thanks, Noel.
Thanks, Bernie. And we have our last speaker, Christian Bernasconi, wrapping up, tying all the threads together and how that impacts real estate and REIT markets across Asia Pacific. And after that, we'd have the Q&A. So Christian runs BNI Capital. It's the largest REIT fund, homegrown REIT fund in Asia. So Christian, please.
Yes, hi, thanks, Noel. First of all, can you see the screen?
Yeah, we see your screen fine.
Okay, I was really just going to talk about the technology REITs that we own and how they've grown in importance in the REIT sector. But the previous speaker, Yuying, spoke about work from home. And as a fund manager, we get a lot of questions from our investors about work from home. It's a pretty big topic because it is a concern of disruption to the office REITs. So we spent a lot of time analyzing and thinking about it. And it's really quite interesting because each country has a little difference in how they adopt work from home and whether or not it will be successful, depending on the size of the company, depending on the country. So for example, here I show Japan, where work from home is actually starting to increase even prior to COVID. And that's part of the reason for that has been the government's desire to improve a little bit of the workers' life-work balance. And that did accelerate, and I think acceleration of trends is something we've been seeing during COVID. It did accelerate, but there is a generally, depending on the company, a different view on it going forward, how they will adopt work from home and telework, et cetera, really depending on if it's an SME. But the byproduct of all of this is that we do expect that there will be greater work from home. It will continue. Large firms are more likely to adopt it than smaller firms. And the byproduct for real estate for us is that we see satellite offices and flexible offices being the beneficiaries of this rather than the centrally located offices, somewhat to the same point that was made before about Singapore. In a big market like Japan, we've already seen in the periphery of Tokyo, property prices and rents rise prior to COVID as companies are trying to make work a little bit more relaxing or reducing the travel time for many of their employees. There are some cultural issues, and there are also technology issues because not all of the firms have moved to sort of a hybrid or cloud solutions. There are difficulties in implementing work from home and being productive, and it does vary, but certainly this trend is in place. So I just wanted to touch on that because it has impacted the way people look at REIT investment and the questions we get continuously from investors. But I was going to I'll go back into what I want to talk about first, which was really data and how important REITs, data REITs have become for the sector. Excuse me, I have the wrong slide here. I need to open another one. Can you see the slide? It shows the FTSE NAREIT All Asia REIT Index.
We can?
Yeah, we see it.
Okay, so this looks, again, this is an acceleration of a trend. You can see that back in December 2010, modern REITs, we refer to them as logistics, data center, storage, and tower, but really the two big parts of that have really grown or really three, has been logistics, data center, and tower. And I would throw logistics somewhat into the technology space, just given the growth of e-commerce and how that's affected that institutional asset type, or how institutional investors look at logistics. Previously, it was more of a industrial. It seemed to be really linked to the business cycle. It didn't seem to be a beneficiary of technology. It certainly today has changed. So flip forward 10 years and you can see in the US that modern REITs, made up predominantly again of data center, tower, and logistics, are now 50% of the market. So they're very, very important. And this has changed the way investors look at people. Investors who run global money or Asian money, or have to have a view on the aspects, the strengths of certain technologies, and I'll touch upon that when we get to data centers, and have a view. So it has changed the game to some degree, not just having a simple view on office, retail, and residential, but now having a much more view based on the different types of technologies and whether or not they'll be successful. So we have recently written an article that I don't know if any of you have read it, but we talked about the data centers and cell towers. Data centers have grown in importance, and I think people in Asia, but also in the US, have definitely view them as a very successful sector. It's a sector that we like and we do have exposure to. I'll give one example in Asia because I don't think it's very well known yet. It's a company called Sunny Vision. That's the largest data center landlord and developer in Hong Kong. It's backed by Sun Kai. So they operate the biggest data centers. They're both retail oriented. It's very similar to Equinix, which does lease to corporates, which do have their either a hybrid or a cloud solution. They will often have many cross connects within the data center, which allow them to connect to applications. The easiest way to think of this is like to take your hand phone and think about when you bought the Apple phone, you've got connections to iCloud, you've got connections to Google Maps, you've got connections to Spotify, you've got connections to Amazon, through Audible. So you've actually connected to several different clouds. You've connected to Amazon's cloud, you've connected to Apple's cloud. You may be connected to Microsoft's cloud. So customers, corporate tenants also have that same need to be connected to Oracle, to Amazon, to et cetera. So they need to be in data centers where there are other applications they can connect to. And when they do that, that creates a certain stickiness. And the landlord that has that data center tends to have a very strong position over a data center owner that has more or less maybe one or two wholesale clients, maybe just hyperscale tenants, which could eventually move out. Having cross connects means that you're being kind of connected, and that ecosystem is very important to you. And that's why we've put a preference on those types of companies that have that that moat. And so Sunny Vision is one of those companies that does that. They do have hyperscale, so they do have Google, Microsoft, AWS, Alibaba in their cloud, in their data centers, but they also have many corporates that have either a cloud solution, which means they've outsourced their storage and have outsourced everything to the cloud, or they've got a hybrid solution where they're still running a lot of their crucial systems internally, but they do have other applications that they run externally through data centers. And that hybrid model is pretty big. And that's enabled companies also to implement work from home too. Companies like ours, being using Teams, allows us as well to access all of our data from our homes and to do our conference calls and everything without having to be in the office. So that growth in Asia is actually accelerating. It's still at relatively low levels, including Australia, relative to where the US is. So we see the opportunity really in Asia for adoption from corporates, and we believe companies like Sunny Vision will have the advantage. There are other data centers, and again, we think some of those could become risky over time because there is a lot of development of data centers. Data centers aren't that difficult, really. It's hard to get entitlement for lands in some place, but generally speaking, those are just doing core and shell and have access to power. They're really at the mercy of their tenants when it comes time for releasing. And you do see circumstances where when leases renew, there is a significant downward pressure on the actual lease rates. So it's not, it's a little bit like Moore's law. It does get cheaper over time. And there is a risk for some data center owners that they'll find that their leases over time will become less valuable, even if the market's still growing. The other area where we think is actually more interesting is on the tower side. And the reason is that it's really just an oligopoly. And this, again, has benefited from the trends that have been in place for a long, long time. Telecom companies are expending a lot on their networks. They need to improve their networks. So they're not making lots of money. They need to spend on 5G. So they've gotten rid of some of the non-core assets like tower ownership, and independents have bought those towers. And when they buy those towers, they then invite other telcos to those towers. The margin on that additional lease is very, very high because there's no capex or operating expense to those tenants. And it's sort of almost an oligopoly where you have in the US 3 main owners of cell towers, and they have the advantage that it's very difficult to build them as well. Nobody really wants them in their backyard. We use the expression NIMBY, which means not in my backyard. So you don't see a lot of new towers being built. However, as 5G rolls out, and because of the technology related to 5G and the ability for 5G frequencies to travel shorter, they don't travel the same length or distance, and they can't go through buildings and things like that. They're going to require more points or more cells. So you'll have small cells and towers kind of working together to create this patchwork that can allow 5G to really be rolled out into major cities. So we do like a company called Crown Castle, which does both towers and small cells. We think there'll be a winner in the 5G race, and we own that in our global fund. So that's kind of what I want to talk about on the tech side. I see we've already run over an hour, so I'll kind of leave it at that. But I kind of say going forward that technology trends were in place before COVID for REIT investors. They've accelerated. In the short term, we have seen rotation out of this space because the valuations did become a bit rich, but longer term, it's really hard to generate the same type of returns in the more traditional space of retail, office, et cetera, especially given the disruption that we're still seeing from this area. So we'll still stay invested here, and we do believe this area will continue to grow. And happy to take any questions.
Thanks, Christian. Maybe all panelists, we could come back and do the Q&A. I think there's quite some questions around the panelist outlook for property markets across Asia Pacific. But specifically, I think for Roddy, there's one question on the accuracy of your information. I think also, especially given the current situation, right? COVID is such a game changer in terms of market volatility.
Sure.
COVID hits, things are down, vaccine comes, things are up. How do you adjust?
So answering specifically the question on accuracy, I mean, the platform is able to get within about 10% accuracy. It really depends. I mean, the richer the information we have on that area, obviously the higher the accuracy we're able to achieve. So, I mean, if we were to look at somewhere very much out in the outskirts of a city where we have less data, then the accuracy would fall off. But we do have a sort of accuracy score, sort of from red to green, to highlight how accurate the information is liable to be. I mean, just talking about the volatility of markets, I think the other thing that the Office Blocks is trying to address is that typically in APAC, and when it comes to tracking direct sort of investment and the performance of individual assets, then typically those are reported on. I mean, obviously REITs are quite a different situation because they're traded very frequently. But when we're talking about the sort of direct markets in terms of rental performance and capital value performance, that typically is reported quarterly. The difference with Office Blocks is that information is updating on a weekly basis. So it hopefully gives a more accurate picture on an asset by asset basis what's happening kind of in the market today.
There's a follow-up question there, which is, what's the source of the information that you have in the system?
Okay, no problem. I mean, essentially, we've been capturing and sort of spat through a wide net out there to all of the public information that we can capture in terms of asking rents in the individual assets, and we've been sort of casting that net wide for the last 5 years. Separately within REIS, which is JLL's data platform, which most of the key direct investors in APAC subscribe to, as you well know, Noel. From past, we then take that granular information that we have within REIS, which is tracking achievable rents, and essentially all of that goes into our AI machine learning, to then essentially bring all of that information up to an achievable rate for all of the assets. I'm probably very much oversimplifying how I'm explaining this, but essentially that's how we're capturing and pulling that together. But it's not a direct lookup on any information. It is genuine AI machine learning.
And we've heard Yuying and Christian share on their views on work from home, and I think the general consensus so far is that you know, it's a trend that has been ongoing pre-COVID, and with COVID, it's going to continue going on. Well, what's the views on office demand? Would it drop off significantly, or will it come back up after COVID and we'll be back to 2019 in no time?
Is that a question for me, Noel? Sorry.
Yourself and maybe
Yeah.
Christian or you might want to chime in as well.
Sure. I mean, in terms of office demand, we actually surveyed 250 major corporate occupiers across Asia Pacific to really try and get a handle on how they see demand for office and their requirements going forwards. Because we've certainly seen plenty sort of capturing headlines of people saying they're only going to take 50% of the space that they currently occupy. Now, interestingly, on average of those 250 corporate occupiers, they were currently taking about 91 desks per 100 employees within their office. So we wanted to really look at how that de-densification, or if there is it might play out going forward. What they told us is that on average, they expect to have about 82 desks going forward per 100 employees. I think Yuying mentioned also earlier that, you know, the office space being for collaboration now. If you think about some of the world's most successful companies, they've invested over the last 10 years considerably in their offices, really to create spaces for collaboration, innovation, etc. So we do strongly think that, yeah, work from home, or more importantly, work from anywhere is very much here to stay, and COVID has moved the needle there. But the office will remain central, as Yuying mentioned, and I think what will happen is there may be less desks in offices, but because people will spend less time in the office and they may have more flexibility, which is a good thing, there will be a definite requirement for more collaborative spaces in offices, whether those be breakout areas, individual meeting rooms, etc. You know, that's something that the mix of how an office is split up will change.
Christian, you're on mute.
I'm going to share the screen again. We kind of talked about that too in that first slide I showed, which I think is an interesting one. It shows office space per person in Tokyo's 23 wards, which was pretty much, I mean, it's about half of what you'd see in the US. So it's pretty crammed in Tokyo. I don't know if you guys have visited offices there, but there's not a lot of extra space. And so in a world where you start to de-densify, and that was actually, again, happening prior to COVID. There's a labor shortage prior to COVID in Tokyo, so it was hard to attract people. One of the ways to attract people is to make the office a little bit nicer. So breakout rooms, a little bit more like you see in the US with a sort of more of a campus feel. So if you visit some of the Tokyo developers' main offices, they're starting to show that as their showcase of the future office. And so coming from a position where people were already jammed pretty tightly, even if you do densify, or even open up sort of flex office or satellite offices, which could happen, you've still got potential that more space is going to be needed in those main headquarters too. So it's not all doom and gloom with COVID. creating this sort of dedensification. And again, it was, again, I think the old office is no longer as relevant in Japan. It is becoming a little bit more of, you know, they do need to attract workers, and making it a nice place to be was something that was starting to happen. So I just wanted to add that.
Do you see a lot of corporates engaging your services, so it's more individuals who need to migrate to the home office? Oh, you're on mute.
I think I'm mute.
Hello, can you hear me now?
Yeah.
Yep. So, okay, I mean, back to what Roddy has said, like about companies sort of repurposing the office spaces, but not really releasing, you know, more office space. Because, I mean, obviously collaborative work, you do require more space per person, right? As compared to like very densely packed kind of like focused desk space. So I've definitely seen that happening. But back to Kristen's point as well, I think a lot of it is very much industry specific, and it's also firm size specific also. So the industries that we've seen which have made a big shift towards enabling remote work are the technology companies, finance, and also insurance, because a lot of their type of work can actually be done remotely. And you know, the kind of office space that they occupy tend to be grade A office space, which could be slightly more expensive as well. So we have definitely seen that happening. For smaller companies, we haven't seen that much of a shift. A lot of them are still retaining the current office spaces that they have. So I think a lot of it industry specific, firm size specific. For the larger enterprises, definitely there's a shift towards the office space becoming a collaborative you know, area, and you know, they may be releasing only part of the office space for that, or they may be just, you know, repurposing the entire space itself. I'm sorry, Noel, you asked another question just now?
I think that was it. And also, I guess, in terms of whether it's corporates or individuals paying for the services.
For our services right now, we have both. So we have individuals, but there's a lot more interest from corporates now. So, you know, part of the function that we fulfill is that there is actually regulatory requirements for compliance when, you know, the people's homes become designated as their workplaces. So there's safety and health requirements over there from a legal perspective. So this is something that we help to enable for companies, and they find that to be an attractive proposition.
Okay. Christina, I mean, ProxyClick, I think is had a fantastic run in this COVID situation. I mean, suddenly everyone has to implement this digital tracking, right? But is it a COVID specific thing? To what extent do companies need your services when this COVID pandemic passes?
Yeah, look, there's always something changing. ProxyClick was really originally founded around making offices welcoming places and making it more efficient to bring unexpected people on site into the office. So managing NDAs, managing how people get there, connecting in with the access control system, so on and so forth. There was a big shift after the Grenfell fire in the United Kingdom. You know, fire safety really became much more prominent around Europe, and ensuring you had a real up-to-date live fire safety list became much more top of mind for corporate real estate managers, rather than just, you know, sort of a paper logbook where someone could write Mickey Mouse. You know, the fire captain arrives, and we have had this happen with customers of ours where the fire marshal has arrived and said, "Is everybody safe?" And they're able to pick up their phone and say, "Yes, everybody is safe," or "No, these 3 people are not accounted for, but I know who their host is, I know what time they came, I know where they're spending their time," and able to contact them. So I think in that COVID has shifted some of the requirements. It's been huge, but the need to manage how people come into buildings, there's always a new catastrophe, there's always a new calamity. The big thing is just being flexible enough to be able to respond to that without just throwing a bunch of manual spreadsheets and processes at people.
Okay, cool. Christian and Roddy, there's also a question around the hotel market recovery. What's your view on that? Are we 4 years out, or would we bounce back to 2019 and next year, 2022?
I mean, from my side, I think it really will depend on the market, Noel. It's something that we've been looking at. I mean, certainly the markets where there's more likely to be domestic demand for hotel rooms, obviously will be more resilient even now. But essentially going forward, it's really going to be determined by what happens with vaccines, people being able to get back and travel. I mean, more casually, I think we all will be delighted to be able to get on a plane and go for a holiday. So I think there will be pent-up demand that will quickly drive hotel demand as well. The biggest challenge really at the moment is in markets where there is dependency in business travel, and business travel really can't happen.
Yeah, absolutely. I mean, I guess you have to segment. There's so many different segments: business travel, leisure travel. You know, in each market's a little bit different. Those that are more dependent on inbound tourism for their markets versus like the big domestic economy. So we have really no exposure to hotels per se in our funds, other than through diversified REITs that do own some hotels. But we do like the domestic tourism plays. For example, a company called Ingenia in Australia, which has a caravan parks, that'll do really well in this environment when people can't leave. So that type of hospitality is actually doing quite well. We are seeing cap rates back up. It's actually the only area where you have actually seen cap rates kind of move a bit. For the most part, even office and most of the markets have been pretty tight. There's no transaction in large retail, so it's hard to talk about that, but smaller assets do trade. Neighborhood shopping centers have done quite well. Of course, logistics and apartments have done really well. Hotels are the one area where you are seeing that kind of back up in cap rates, and you're also seeing quite a lot of lease modification from tenants, from operators. So that's really impacted quite negatively the hotel space. We're happy we're not there. The market that is obviously the one that everyone kind of looks at in Asia is Japan. It had been very successful in attracting tourism because of all the changes that were put in place since the early 2010s to allow for greater access for people from Asia. And that market was continuing to accelerate into the Olympics, but clearly COVID has impacted it the most or dramatically. We do think that will come back, but it will take some time before people really will be able to travel at the same way. Obviously, the vaccine will help, and people are starting to price that in. But just speaking to the companies, our analyst had a call with one of the owners of the Shangri-La today in Tokyo, and they have seen domestic demand be okay, but it's clearly not as good as it was a year ago, because they're really missing that big element. Even as there's been some substitution where people don't travel to Hawaii or go someplace else and decide and have to stay home, that's helped, but it hasn't offset the loss. So it's going to be there for a while. I think it will recover, but it's probably going to take a bit of time.
Thanks for that.
And Airbnb is listing today, and that shows you really what people think is that people do want their travel, but they also want their safety.
Yeah, thanks for that. Whereas I think what we see is that the rentals, as you mentioned, have come down a lot, and what we're seeing in that space is that where previously we used to be purely on fixed rentals for the length of the term, now we're seeing a bit of a hybrid, a bit of a staggering of the rentals. So the base rent staggers over a number of years. It marks up over a period as people forecast the recovery. And there's also a bit more of a profit share component, so as to lower the risk for the tenant as well. I think importantly for KHotel, what we see is that we're not really contingent on the recovery of tourism per se, because we are able to absorb the room supply even in the current environment where it's largely domestic travel and per person stuck in Singapore, for example. And in terms of the returns that we can drive on that, actually, because we don't own the building, we just lease the building, the returns that we're able to drive are much higher. On a project level basis, we can drive as much as above 50% IRR even on a project basis. So that's really why we're quite bullish on the hotel market, but slightly different perspective, because we're not so much a buyer or owner of the hotels, but more so a tenant and operator in another sense. Maybe a question for Bernie. What do you see as the broader tech elements that companies or real estate firms, owners, and operators can adopt to position themselves for the future?
Thanks, Noel. I think there are a couple of key things along the lines of what I talked about, and one is definitely around improving data and getting the basis of data collection right. So instead of 10,000 spreadsheets and collecting the same data over and over, just collect it once, validate it once, and reuse it many times in all your processes. I think that's one of the core things I think a lot of organizations have learned. And two is around really understanding the management information that needs to be surfaced and the timeliness and accuracy of that, which goes back to having that foundation right. And then I think the third thing is really around interacting more effectively with tenants. So really understanding what tenants need, and you know, particularly as everyone is in this uncertain period and corporate real estate managers are trying to figure out what does that really mean for the layouts of their offices, the space they need, where they need it, the types of fit outs they need associated with that. There's a lot of question marks. I mean, we've heard it today from different perspectives of what could be. Everyone is very much in the space of waiting to see what happens, rather than saying, yeah, this is the way we're doing it. And therefore, I think it's important for landlords in particular, REITs in particular, to understand that real estate managers are in that situation. Flexibility is king, and the ability to, if you went to people 10 years ago, landlords 10, 20 years ago, and said, I want flexible leases, they would say, no, that's too hard. I can't manage that, right? My systems are pretty straightforward. Today, property management, lease management systems are far more adaptable and flexible, and therefore, I think landlords can go that extra mile and say, yeah, we can manage a more flexible lease arrangement because we have the tools to do it with, or maybe they do, and therefore, achieving that sort of higher level of occupancy through greater flexibility. And not being as concerned about what the whale looks like as a result, because they know that they have the agility in their own business process to deal with that.
Okay, thanks, Bernie. So final question before we all break for lunch and everyone goes off. In terms of outlook, and sequence-wise, perhaps the same sequence as we all spoke today. So Roddy, Christina, and so on. Sorry, Christina, Roddy, and so on. What's your views on outlook for the next 2 years, for example? How will markets recover? Whether broad real estate subsectors or whether your own area of expertise. So, Christine?
I think, look, there's some of it that's going to be like, the smoker that gives up smoking for a couple of months and then, over New Year's, and then come February, he's back down at the pub with his friends and he's back on smoking, right? I think there's a lot of talk. We'll see if people actually have the courage to push through some of the changes. At the same time, I think those changes have to be driven on a tenant level perspective from better alignment between HR, IT, and workplace and facilities. I've seen in a lot of companies that these silos have been being broken down over COVID as they are sort of forced to work more closely with one another. And right now we're kind of in that position where you've got 20 decision makers instead of 5 for each big decision, but hopefully that's going to start and have a bit more of an employee experience focus rather than such silos. I think from a landlord perspective, they're getting a lot more creative, which is good. The power has shifted in a lot of ways more towards the tenants. And exactly what the team was talking about here today around flexible leases. It's a big shift, And the whole idea of sort of just having facility management, you know, you're cleaning your operations, keeping the air conditioning on, it's not going to be enough to really compete and to have high yields and low spillage in the coming 3 years. But interested to hear what you guys have to think.
Okay, from my side, I think as we go into 2021, I think it will still be challenging in the office markets in terms of rental returns, because, you know, we're still in this period of flux. However, you know, based on our forecast that we've just put out, if we look over the sort of longer term, we do see a strong recovery for office. There's scope for yields to further narrow in the office sector. I think we've touched a lot on today, you know, what will happen in the office in the future. Definitely there'll be change, there'll be evolution, but much of it for the good in the end. I think when we look at retail, again, it's a similar situation of evolution now. Short term, non-discretionary retail will continue to hold up very well. If we look at over the longer term with discretionary retail, when it comes to malls in Asia, we are more underbuilt than other regions are. But at the same time, I think the key trends of sort of evolution of that space, landlords will have to be more agile in developing those sort of omni-channel pieces around retail. I think there's also an opportunity maybe for some of the retail assets, especially in more mature markets like Australia, for some sort of hybrid of, you know, potentially having some last mile logistics in some of those underperforming assets. If we look at logistics performing particularly well, within the next 3 years, APAC will account for 50% of the logistics market, globally. So I think there's strong opportunity there in logistics. We've been asking the question, and we reached out to that investor group to ask them around logistics and what they plan to do. 81% of the investors we spoke to saying they intend to deploy more capital to logistics in the next 18 months. We just had our future forum last week. We asked the question, is it too late to put money into logistics? Because everyone's targeting logistics, and strongly that group said no. So I think there's definitely opportunity out there. One key theme that we are looking at across the market is, because COVID has accelerated many mega trends, there's definitely going to be some obsolescence in assets out there. And that also creates an opportunity for value-add investors. And unlike previous cycles where it's flight to safety, and what we're seeing here is flight to safety in terms of these typical markets like Japan, likely to see a lot of capital deployed there. But also what we're seeing is people at the same time moving up the risk curve investor-wise, just due to the weight of capital and the opportunity and higher returns that can come from some of these alternative and emerging sectors. And with that, I will pass on. Thank you.
Hi, so from my end, I absolutely agree with Christina. In the line of work that I'm in, I've seen a lot more collaboration between HR, CRE, and IT. So CRE being corporate real estate or facilities management. So basically with HR driving the policy changes, and corporate real estate or facilities and IT driving the execution of it. So I think we're going to see a lot more closer collaboration in the next 2 years. In terms of the real estate market itself, I think that the pendulum has really swung towards remote working and work from home during COVID itself. And I think that the pendulum will swing back, once the COVID vaccine comes up, because people may be tired of working from home, they want to see their colleagues again and so on. The question, I think for me personally, in the next 2 years is, where will the pendulum eventually rest? Will it swing back towards the office, or will it swing back towards work from home? I think that the big test is when leases become due. So, as we all know, corporate leases are long. So I think that, a lot of companies are still locked into their leases. So as the leases become new, do companies increase their office space? Do they keep it the same? Or do they actually decrease it? I think that that's where the big test is going to be. Personally, I think that in the central business district, if enterprises can find new reasons for their offices to exist, so for example, as a clubhouse kind of concept or as a kind of collaborative space, that office space here in the CBD might not be impacted that much, at least in the short to mid-term. But I do think that there are opportunities for satellite offices and also for flexible spaces to go out into the suburban areas as well. So those are my points of view.
Okay, thank you. In the hotel space, I think some of the baseline forecast or more pessimistic forecast put recovery to 2019 as far out as 2024, 2025, so 4 to 5 years in. At K Hotel, we're slightly less pessimistic. We think, well, we hope there's a recovery next year, probably not second half next year. Might not be fully to 2019 levels, but you know, things will recover well enough that hotel markets would go back to a semblance of normality. What we do think is by 2022, things should come back to some semblance of normality because the vaccines are out, people are getting vaccinated. We think that the business travel market might be permanently impacted to some level because everyone's a bit more used to Zoom and conferencing like now remotely as well. So there might be less business travel as a structural factor going forward, but that's something I think we can't really tell for certain. In terms of our business, we're a bit more optimistic because what we're doing now is actually signing long-term leases. At this bottom of the COVID market, we're signing leases of up to 5 to 10 years now. So really locking in leases at a time when they're really cheap because lots of hotel buildings are sitting empty. So I guess that's in a nutshell how we see the hotel markets across Asia. Bernie?
Yeah, thanks, all. Thanks. Yeah, look, I think I'd agree with a couple of the points that other speakers have made, but maybe take them a step further and say that, you know, I think what we're definitely seeing is, you know, some merging of use types in asset classes, and that's potentially challenging for REITs given their investment mandates. You know, I think when you say, okay, we're going to see some last mile logistics and maybe some serviced offices in suburban shopping malls, and you say, well, how's that going to play out in terms of I've got this asset and my mandate for is really retail, you know? So there's some challenges there that I think are hidden in the detail. And secondly, there's no question, I think that particularly for AsiaPac, data centers and logistics are really going to continue to be very strong sectors. There are numerous markets where those things just you know, are way below where they need to be compared to other markets. And the third thing I'd say is that I think, you know, retail and office both have some challenges, mainly because of uncertainty, like we've talked about. No one really knows yet how it's going to play out. So I think a lot of investors are hanging back a little and saying, what is this really going to play out like? Yeah, there's no question that, you know, the braver investors are probably saying, yeah, we'll get into those sectors because we know they're going to recover. But the question is by how much and when, you know, and how sustainable is it given other changes structurally. And I think, you know, from a tech perspective, one of the big things that underlies all of that from a landlord's perspective generally, whether you're a REIT or not, is I think around the ability to be agile and flexible, the ability to say, yeah, I can handle that type of lease. So for a retail mall owner to say, yeah, I can do a lease where I share some of my truck turnaround and loading bay with a last mile logistics facility, or, you know, I can do a serviced office type lease, right? Maybe I'll become a serviced office operator even in part of my space, right? The ability to be flexible and agile, not just in terms of your people and expertise, but also in terms of your systems and processes. I think there's some of the things that people need to think about in terms of challenges, and just the fact that, you know, what I see generally is a lot of these things are merging, the use types, etc. I think we're seeing much more I guess the non-Western model of mixed use development be as a use case becoming more apparent in multiple markets. You know, if you think about the origins of shopping malls, is really the village square. So if you think about that as a concept, you come back to a very different model as to what shopping malls might evolve into now that, you know, not just the pain they were having before COVID, but the pain of COVID may well drive communities, societies to rethink how they're going to use those spaces.
Yeah, just to conclude, in the public space, definitely everyone's in love with DCs and logistics, and we very fortunately were overweight both going into the crisis. Not, we didn't increase it, but my biggest concern is that too much capital could flow into these areas because they are very attractive. We're invested in companies like Goodman and ESR, which are fund managers and developers of logistics, and they've been very, very successful in attracting capital from GIC, CPPIB, APG, the big boys. Every incremental dollar is going into logistics or even into DCs from investors from Europe and the US. Nothing's going into retail. So, supply does create over time imbalances. So a bigger concern I have is that we do get too much capital rushing in. We have seen cap rates compress. In the US, cap rates for logistics are about where they are for office. That wasn't historically the case. There is still spread in Asia over office for the most part, but that's compressing quite quickly. So there is a risk that, too much capital comes in, but, markets like Japan are still very, most of the stocks are quite old. So to Roddy's point, we will see this modernization or replacement, taking out sort of obsolete logistics, and that's really for efficiency for retailers, for e-commerce companies, and for pretty much anyone who needs to lease logistics space. So that will continue for some time. So I think it's too early to be too worried, but there's definitely this is definitely a story that's pretty well known. The good thing also is that about a crisis is it does limit development of other types of assets. So I think you're not seeing people developing malls, you're not seeing neighborhood shopping centers being developed. It's very hard to raise capital to do so. Banks probably don't want to lend there. Ditto for hotels. And so that should bring us back into some equilibrium going forward for the next 2 years. And then just to kind of sum up, I'll just show you a slide that we showed to our investors yesterday that shows what the public market looks like and how it thinks about REITs versus other asset types. And this shows the relative performance on a 1-year total return basis of REITs versus Asian equities. So think of our whole sector, including Australia, versus stocks like Tencent or other equities in Asia. And over the last 10 years, Asian REITs have outperformed, but they've done it in waves. And this has definitely been a period where traditional REITs have really been unloved. So if I think forward 2 years, I would think as we get closer to a vaccine and more normalization, I think we would probably see, at least in the public markets, a repricing of the more COVID impacted sectors. Not that industrial and DC won't do well, just I think the others will start to do some of the lifting because year-to-date performance for logistics in DC is generally positive. That means for the rest of the sector, it's been quite negative. So office, retail, et cetera. So, normalization probably should bring some mean reversion here. And I do think we're set. If I look forward 2 years, Asian REITs should be well positioned, and REITs in general. If I use this is not different for our global funds. Again, fortunately for us, we were in those spaces that were kind of the secular growth stories that we like, and we think they'll stay strong. But you do need a barbell because we will get back to some form of normalcy, and when that happens, there's upside in the other types as well.
Thanks,
in the public market.
And thank you all for joining us today on the COVID Tech and REITs webinar. I hope you enjoyed the sessions and found the content shared by the speakers very useful. And again, thank you all speakers for joining us today. Thank you.
Thanks, everyone.
Thank you.